Okay, here we go for session 4. You can read it all in the book Financial Analysis and Business Valuation, and today we're going to talk about the equity cash flow, and I'm going to give you a practical example how you have to calculate the value based on the equity cash flow. Now remember, equity cash flow, it's the earnings after taxes plus the depreciations plus or minus the working capital requirement mutation minus the recurrent investments you're doing and the repayments of the debt you have to do towards the bank. Now, let's go to a practical example. Let's assume that the company I'm going to show you has an average investment she does yearly for recurrent investments of 400,000, and that the taxes are 25%, and that the dividends of the last year do amount 4.6 million euros. Now, let's start. All right, here is the balance sheet, the asset side, and here is the liability side. Now let's have a look to the P&L. Here we have our P&L with an EBIT of about 6.8 million euros in the last period. Now remember, no financial analysis without making a managerial balance sheet or compressed balance sheet. Remember, you're going to put the working capital requirement on the asset side of that balance sheet. Now, to remember again, the working capital requirement is nothing more, in fact, than the inventories to customers minus the outstanding suppliers and eventually some other amounts, non-interest-bearing debts that you can find on your balance sheet. Now, as you see the managerial balance sheet, you have the fixed assets, and here you have the working capital requirement. Always remember, dividends are not in the working capital requirement calculation. You have to take them out of your working capital requirement and bring them in deduction of your cash amounts you find on the balance sheet. Important is that you see here an evolution of the working capital requirement from 5.5 to 7.3 million. That means that this company is consuming cash due to the increase of the working capital requirement. Okay, the company I'm using is one of my own customers, and you see that this company only has equity and has no debt. I did this on purpose because I want to build up for session 5 the situation in which we have a lot of debt, but this one is a very easy one. It's one without any interest-bearing debt and just equity as invested capital. Now remember, no financial analysis, no valuation without knowing the mutation of the working capital requirement. I do repeat that the whole time. Calculate your working capital requirements every month for a period of at least 5 years, so you know exactly what's going on with the working capital requirement, and also that you know what is fixed as working capital requirement into the company and what are the mutations. Remember, working capital requirement fixed has to be financed by the net long-term financing, and the mutations have to be financed by short-term interest-bearing debt. It's a very important one. Now, what valuation method I'm using now? It's only this one. It's the equity cash flow method. Equity cash flow divided by cost of equity minus the growth rate. And remember, it's an equity valuation model. Now, what is important, if you saw the formula, when you have this value, you always have to add the net treasury of the company. Net treasury is in fact an excess of cash, and someone who's taking over the company has to pay in addition this excess of cash. So the net treasury calculation is very important. How do we do it? Very easy. You just calculate the net long-term financing. In this situation, it's 9 million euros. The next step is you compare the net long-term financing with the working capital requirement. In my situation, the working capital requirement is 7.3 million in the last year and 5.5 in the previous year. Remember, in my example here, I'm going to take the assumption that this working capital requirement you are calculating is fixed into the company. All right? Okay, this is the calculation of the net treasury. You just take your net long-term financing, you do deduct your working capital requirement, and if here we have the assumption that this working capital requirement is fixed into the company, we have a net treasury of 1.7 million euros. Remember, this is a net treasury which is left after the dividend of 4.6 million has been paid out. The net treasury you're calculating should always be recalculated, and the major question you should ask to your customer: what are the normal days that suppliers are outstanding? And if the customer would answer you with 30 days, that would mean that the outstanding suppliers, they could be 1.4 instead of 2 million euros. That means that the suppliers would be less outstanding for 625,000 euros in the last year. That means that the net treasury would be less for an amount of 625,000 euros. Or if the customer would answer, no, it's 60 days, your net treasury does increase with 770,000 euros. And if he would say its normal days of payment is 90 days, your net treasury will increase with 2.2 million euros. That's the first reason why you have to ask always what are the normal days of supplies that are outstanding. Why do I not ask you how many is the days of how many days the inventories are outstanding? Because the companies, they try to get their inventories as low as possible. It's very difficult for them to influence the amount of days of outstanding inventories. And the same thing for the customers. They try to get their money as fast as possible, but it's very difficult to get it faster sometimes. But what can they influence? Their days of supplies. They can pay it faster to have a deduction, a financial return, or they could pay a little bit later because they have a cash problem. So very important for the net treasury calculation, ask what are the normal days that these supplies are outstanding. But secondly, if you know the normal days that the supplies are outstanding, it will also influence your mutation, of course, of your working capital requirement. And if, for example, here we would say the normal days is 90 days of working that supplies can be outstanding, we can see if we would recalculate our working capital requirement that there would be a mutation that differs from the one we calculated in the last year for approximately 4 million euros. And here in 60 days it's 2.6 and in 30 days it's 1.2 million euros. This is a very important one to decide whether you're going to take into account the working capital requirement mutation in your cash flow calculation. Now, if I'm calculating the equity cash flow, I start from my earnings before taxes. I do deduct or add my extraordinary income and extraordinary charges so that I have an operational result without any exceptional items. I deduct my taxes, I have my net operating result, I do add my depreciations, and I have a cash flow available before investments. Assume that it was 400,000 recurrent investments, I will deduct 400,000 from this cash flow. But look here, my mutation of working capital requirement I put on 0. I did that because I heard from my customer that he has 90 days possibility to pay his suppliers. So the mutation of the working capital requirement I had in my balance sheet is one I'm not going to take into account because he's paying his suppliers much faster than he normally could do. And that means that this mutation of this working capital requirement, for me, it's my decision, has not a mutation that I have to deduct from my cash flow, because it's not a working capital requirement that is increasing the whole time. It's just a working capital requirement that goes up a little bit up and down due to the days he's paying his supplies, but his supplies are paid much faster than the 90 days. So here you decide in this example, it is no working capital requirement you're going to deduct for your cash flow. Now, if you would have a customer which is increasing the whole time his working capital requirement and there is no other possibility, you have to deduct, of course, the mutation of the working capital requirement because you won't have the cash anyway afterwards, because you really have this increase of working capital requirement. Remember, this is an easy company, no outstanding debts, so that means capital repayment is 0 in this example. And we do see amounts written off 0. Remember, it's always 0 if it's taken into the working capital requirement mutation. So the equity cash flow here is 5.8 million euros. In session 5, I will explain you how you have to calculate the cost of equity. Now, let's take the cost of equity here just on 14%. Here we have the value of the company. If your equity cash flow is 5.8 million euros, you have 14% cost of equity. The value of the company will be 43 million euros. Now, it's a little bit function of your number of normal suppliers you can be outstanding. If it would be only 30 days, you will have some net treasury less, because this is the calculation plus the net treasury you calculated out from the historical balance sheet. But if you would recalculate the suppliers days, you remember 30 days, that means there would be less net treasury. The amount of value would be 42.7 million. But for example, if it would be 90 days, your net treasury will be higher, and you have a value of 45 million euros. So remember, 5.8 divided by 14% will give you an amount, and always add the net treasury. Now, this is only the beginning of valuation, because first of all, this is a formula on eternity. And we will start a little bit later on to make different periods. We call it a 3-step period. So it's a very, I would say it's an example of valuation, but you still have a long way to go to have exactly the right amount this company is worth. Alright, I'll see you back in session 5, where I will explain you how you have to calculate the cost of equity, and we'll continue with free cash flow calculation to really come in shape and to start to know exactly how we have to do these valuations.